Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders as always. Anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today we welcome back Jacob Lerner, BofA Securities at Bank of America. Jake, we haven't had you on since September, and I know you have a lot to fill us in on, so I'll let you take it away.
Thank you very much, Rachel, and thank you everyone for letting me come back and speak with everyone. So today I'll be going through some themes we've seen in the market from an interest rate and macroeconomic perspective, and then how some auto dealer clients are trying to manage those risks and mitigate potential rising interest rate expense or the fact that rates might be higher for longer. So a lot has changed since we spoke last in September. Not much has changed with floating rates, where rates have remained at 5.25% to 5.5%, which is expected to be the Fed's the peak of their hiking cycle. What has changed, though, is the expectation for when and if the Fed starts cutting in 2024. So what has really propelled the risk for rates to stay higher for longer is just a really strong United States economy. Following the Fed's meeting in January, the market, so the forward curve for swaps and where the market is pricing in floating rates, a la term SOFR or SOFR, was pricing in 6 cuts in 2024, which is 150 basis points of reduction. So said another way, moving that 5.25% to 5.5% to 4.75 to 3.75 to 4% by the end of 2024. That has now changed. That has been reduced in line with the Fed's dot plot to 75 basis points or 3 cuts in 2024. The reason being, first and foremost, was just robust jobs data in the form of non-farm payrolls in both January and February, showing a really strong economy and really many jobs, more than expected, being added in those respective months, with 353,000 jobs added in the month of January, followed by 275,000 jobs added in the month of February. What that also showed was continued pressure on inflation, both from a consumer perspective and CPI and core CPI, and then from a production perspective in PPI in both months. So essentially showing that the Fed still has some work to do in order to curb what has been decades high inflation in the U.S. economy. So the Fed's forecast, as I mentioned, is 75 basis points of reduction in 2024. That's in line with what with BofA Research's forecast, which is also 75 basis points by year end of 2024. The market has also seemed to coalesce around this, but what I would say is that it seems like the trend over the last 3 months has been for the Fed to potentially pull back on their cuts. Which means that rates might stay at these elevated levels for longer than people might have expected and hoped originally. At the last Fed meeting, which was last week on the 20th of March, the Fed released a new dot plot, which is shown here in the top right of the screen, which essentially, for those who don't know, is where each of the individual Fed board members, including Fed Chair Powell, plots out rates at a given time. What changed with the dots, other than the median, was that we were one person away effectively from them showing 50 basis points or 2 cuts instead of 3 cuts. So again, showing that the narrative and the trend is that rates might have to stay elevated for longer than expected in order for the economy to come back down to earth and for the Fed to prove that they have done their job in terms of combating inflation and a very strong economy. So that's essentially the overview of what we have seen. Now, broadly speaking, this slide touches further on that. We still hope for a soft landing in the economy. That is still B of A Research's economics team base case for a soft landing and the Fed to deliver the U.S. economy into a graceful exit from the high inflation we're mentioning. But as I was discussing before, there are risks to this, and that is that there's one, high inflation keeping rates higher for longer and a higher neutral rate, and then two, the geopolitical and political risks that exist beyond the fundamentals that we were talking about. So to touch on that quickly, that's a common question that we're seeing right now for a lot of our clients, specifically our dealer and commercial real estate clients. And that is, how would this election upcoming in November potentially affect the views that we're talking about now and the forecast that I had discussed? And what we've heard from our research rate strategist recently during a call, and Mark Cabana was talking about how it's possible for the election to potentially sway timing of those cuts. So B of A's official economics research team forecast is for the first cut to happen in June of this year. But that's right before the Democratic and Republican conventions in the summer. And then there's another meeting in September, which is right before the election in November. So in order for the Fed to appear nonpartisan, the Fed either has to start the cutting cycle before the summer in June, which is in line with our research team's forecast, or potentially after, as to not show that they're beginning a cutting cycle in the midst of what is decidedly going to be a contentious election here in just a couple of months. So now that moves us on to what are our clients doing to think about this risk and potentially put some parameters in place to understand what their interest expense is on floating rate debt. And this is something that we've talked about before, but that is mostly still interest rate swaps and interest rate zero cost collars. And on the right here, you can see that you still can get a pretty sizable day one savings relative to swap rates by locking in fixed rates relative to floating rates. So today, term SOFR is around 5.32%, and a 5-year swap rate is at 4.08%. So that is 124 basis points of savings relative to the current floating rate. Now, if the forward curve does play out exactly and the market matches what the Fed ultimately does, then you'd end up net neutral. But regardless of the fact, day one, you get some full certainty on what your expense is, but two, you get a reduction in that floating rate, at least for the next couple months before the Fed's expected to cut. However, I would say that given that there is an expectation for the Fed to lower rates and the hope that the Fed lowers rates, we've seen continued interest in strategies that allow for clients to get more of a range of outcomes in both their interest expense and the participation level going lower. So, comparing the 5-year tenor again, folks can lock in a 4.75% cap strike while allowing themselves to participate all the way down to 3.3%. So said another way, you get basically two cuts of reductions, 50 basis points in this case, 57 basis points up front, while also allowing participation all the way down to 3.3%, which is over 200 basis points of cuts, so another 8 cuts. So an interesting idea for folks that are maybe not comfortable with the floating rate interest expense that they're seeing now, or just want ways to put some barriers around what their interest expense might be on floating rate debt going forward. I also wanted to include an idea that is a little bit more outside of the box, but something that we've actually been doing with a couple of dealer clients recently, and that is a knock-in collar. So it's very similar to the collar concept that we just mentioned, but essentially allows you to get a wider participation if the Fed does in fact cut more than the market is expecting. So here, what we've shown is it's a 3-year tenor on the top example here, and basically for the same 4.75% strike, a client can participate all the way down to 2.75%. So another 105 basis points by doing this knock-in strategy. And what the knock-in strategy does is essentially, instead of being fixed at the floor, if term SOFR is below the floor, you would jump back up to the 4.75% strike, the cap strike that you began doing or began paying interest at in the beginning of the strategy. So it's basically a way to increase your participation lower by giving up some of the downside beyond the 2.75% floor strike in this case. So a little bit outside of the box, but something that, given how high interest expense has been recently relative to the past 15 years, and the desire for some sort of protection and immediate reduction in interest expense, something that we've actually seen more interest in from dealer clients and other corporates alike that are not accounting sensitive, as this would not allow to get good hedge accounting. But I can stop there. I would love to hear if there's any questions on either the market currently, any of the forecasts we mentioned, or the strategies that I just discussed for clients to manage those risks.
Jake, we haven't had any questions come in, but what are some questions that you typically hear or some frequently asked ones that you come across?
Yeah, so I think another interesting concept is where the neutral rate is longer term. So we hear a lot of clients saying, we're waiting for rates to go lower, or we think rates will go lower, so we don't want to do anything and we'll just wait and see. Well, in that case, that's completely fair and makes sense. There is an expectation for rates to go lower. However, part of that is priced in the market. The traders across Wall Street and institutional investors basically bet on where each of those, where floating rates will be at a given time. That is the forward curve for SOFR, and that is when we say the market expectation or what the market is pricing in. That is essentially where traders across institutional funds and Wall Street are betting on rates to be on their trading desks and market makers. So one, that reduction in rates, at least as the market expects, is what is priced into swap rates. But I think the more interesting question is, beyond the 2 to 3 year point, what is the Fed's longer term neutral rate? The Fed themselves say 2.5%, which basically shows a 50 basis point or 0.5% real rate if you think about 2% inflation being the target. So the 2.5 versus the 2%, the 2.5% rate versus the 2% inflation. Well, that's in a Goldilocks scenario where the Fed expects on average rates to be. But if you think that inflation might remain sticky and remain high, elevated above 3%, that actually puts the Fed's neutral rate, or where floating rates end up longer term, around 3.5%. If you think about a 3% inflation and then a 50 basis point real rate, rates end up about 3.5%. So, this is a moving target and something where the market is trying to come to terms with, given that over the last 15 years, we've seen rates at effectively zero following the Great Financial Crisis and the COVID pandemic, which created some black swan or outlier socioeconomic and geopolitical issues that caused rates to be so low for so long. And now we're in a world where hopefully we don't see either of those types of things happen. So it's starting to think about where that neutral rate is longer term. And I think getting comfortable with rates probably being higher than they had been on a go forward basis. Obviously, we don't have a crystal ball. It's difficult to say exactly where that ends up. And there also is obviously the risk for other events to occur unbeknownst to us and outside of the fundamentals that we're talking about, a la inflation, employment, GDP, et cetera. But I think that's always an interesting point and something that I think we're still trying to figure out right now as a world or as in America right now.
And then we had another question come in. What is the upside of the knock-in strategy for the client, given that if the rate hits the floor, the rate goes back to the strike price? So we're all just trying to figure that out as well.
Yeah, so that can be structured in different ways, but the benefit there is if you have a view, this actually goes along with the last point about the neutral rate. If you think that if you have a view that the Fed's going to end up, let's say, above 3% longer term, especially if you're looking at like a 3-year tenor like we showed, well, the benefit then is you're getting the initial savings from the cap and the protection in the case where the Fed stays where they are now or hikes. You're getting that protection, which is the reduction between the floating term SOFR rate at around 5.32 to 5.33% from the 4.75%. Then you're also getting over 100 basis points of Fed cuts if the Fed cuts more than the market is pricing in. So right now, if you think about where swap rates are and what the market is pricing in is that neutral rate that I was mentioning, that's at around 3.55, 3.6%. So in theory, if you believe the market or believe the expectations of or forecasts from a lot of banks, the knock-in strategy allows you to, one, get the participation or get the protection on top, and then two, in theory, perhaps just float down to where the Fed might end up longer term, somewhere between 3 to 3.5%. But that's the benefit, extra participation. Or if you have a view the other way, where you have a strong opinion that the Fed might never get below 3.5%, you can just buy down the cap strike more. You can get larger day one savings. So maybe move the cap strike down to 4.5%, and then you can move the floor up higher. So they're moving pieces, and they can be structured in different ways. But it's a way that you can either express a view or just get more participation on the bottom if you want to float down further. So yes, you do give up in outside scenarios that participation, because instead of being at the floor, you jump up. But at the same time, you can kind of solve for a level that in theory might not be reached. So it's just an interesting idea. And I think in today's market environment, we've seen that clients are just interested in hearing different ways to potentially reduce interest expense. And that was one that we've recently gotten some attention on.
Well, Jake, thanks so much for joining us today and for giving us a peek behind the curtain. This is some really helpful information. Again, you will all be receiving a copy of this webinar by early next week. To those on the line, join us back here on Tuesday, April 9th at 2 p.m. Eastern as we do our used car super session. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.